Hey everybody, it is Friday, and hey, it's time for calendars, and butterflies, advanced option strategies. My name is Brent Morse, and today I want to talk about what's going on in the world and how that can affect the markets and how trades may be impacted by that, and that may impact whatever trading strategies you do or stocks, particular companies or industry groups you look at. So we're going to be dealing with that in a sec. I'm joined by James Boyd in the chat. Always appreciate James. So as you have questions, feel free to type them in the chat. Between James and myself, we'll do our best to help you out with those questions there. Also, make sure you check out James' Investing Master Series on Tuesdays, 11 o'clock Eastern Time. So you can also follow us on X at Brentmore CS, at James Boyd CS for additional content throughout the week. Now, let's hit up our disclosures real quick, and then we'll get to the matter at hand. Options do carry a high level of risk and are not suitable for all investors. And the material today is intended for general and informational purposes only, general informational and educational purposes only. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The paper money software application is for educational purposes only. Rolling strategies can entail additional transaction costs. All investing involves risk, including loss of principal. There's no guarantee that execution of a stop order will be at or near the stop price. And past performance is no guarantee of future results. Schwab does not recommend the use of technical analysis as a sole means of investment research. So here we go. Let me head on over to the Thinkorswim desktop software. This is the market. You all know what's going on in the world, and we're down another 1%. On the S&P 500, we had this kind of nice little channel going. Even up to yesterday, it seemed like that channel was holding, but right now we're below that. So definitely some bearishness in the market. And you could see that reflected also. There was some pre-game chatter, so to speak, before this webcast started on oil prices. It's oil prices. You see the big jump up today. So, I think obviously the people were hoping that the Strait of Hormuz wouldn't be closed down, or there'd be actual shipping going through it. And even if it's not officially closed, practically, there's not much going through it right now. And you see this in oil prices. Here's crude oil. You could do Brent crude as well, /BZ. We're not going to talk about trading futures today. This is just looking at oil prices. And I know some of you are going, oh, I don't want to fill up my car. Yeah, it's going to affect oil. I haven't looked at the pump lately, the last few days, but here's gasoline futures. So, there's a difference between crude oil and gasoline, but here's gasoline futures, and you can see what's happening there. So I'm quite confident you will see some significantly higher prices at the pump there. But how can we, given this, that's all kind of bleak, what I'm talking about at this point. But what, where could we trade if we wanted to take advantage of something maybe more bullish in the market? Okay, you can obviously do bearish trades, no doubt. But I used AI. Here's what I did. I went to AI and I typed in something to the effect of, what industry groups are likely to benefit if the US-Iran war drags out? Okay? Simple enough. Anybody can do that. And it came with some very unsurprising results. Aerospace and defense, energy, oil and gas, shipping and logistics, cybersecurity, and gold and safe haven assets were kind of the five hits there on that. That's something you guys can all do, right? You guys know how to do that. You can use AI and do that. In case you're not, in case it doesn't come to mind. I mean, I'm sure defense stocks kind of may come to mind, but maybe you weren't thinking of, cybersecurity. Maybe that could benefit. So you can use AI to do this. And so you can then look at individual sectors or industry groups to whittle it down. So, for example, I could just pull up the aerospace and defense. Okay, here's aerospace and defense. And this is, how do I do that? You just click on your watch list, you go to industry, you go to industrials and aerospace and defense, or you can go to, certain other categories. Maybe there's nothing that you really see though that fits the bill, so to speak, in terms of where, what industry it would be in. You can go to the sectors and industries list and get a list of different industries. And most of them are pretty straightforward, but I was looking for like shipping and logistics. Well, I didn't really see anything that fit the bill. You know what I did? I just typed in AI, hey, give me some of the bigger shipping and logistics types industries. Okay. Well, one of them it came up with this Maersk, right? Am I saying that right? I always read it, but I don't say it. Maersk, right? That's actually an ADR. There's no options on it, so I'm going to skip that. I'm going to skip that one. And there's other ones you may look at that may be ADRs or don't have options or don't have liquidity on them. So you can buy a stock, but if you're doing options, that is certainly a key consideration there. Okay. So, but I thought, well, let's look at some trades, and I'm going to take these as more of a bullish trade. The market's very bullish right now. I mean, the market's rather bearish right now, but some of these sectors may be more bullish. But in either case, what we're seeing the effects of is higher implied volatilities. Higher implied volatilities can be beneficial in that premiums can be higher. So I know, a traditional iron condor may not be what we're looking for here. We'll look at some examples on this. But the higher premiums actually may put them kind of back in play, perhaps. We may spread them out wider. We may skew one side more bullish or more bearish. Maybe we make them unbalance them too. We can certainly do that. But implied volatilities would tend to help us in that regard. And of course, if it goes the opposite way, then we can get hurt. And that's exactly what happened last week. Last week, we did a trade in this webcast, a bullish trade on Procter & Gamble. So right about here, okay, so let me just kind of zoom in and see what we were looking at last week. That would have been right here, I think. We were looking at Procter & Gamble. And we said, hey, let's do this bullish trade. Well, sure enough, it dropped, okay? It dropped significantly. War does that to certain companies. But of course, we can look at other companies, and we can look at like ExxonMobil. This is one that would tend to benefit from higher oil prices. We've already seen higher oil prices, and we've already seen some bullishness in this. But if we think this is going to continue to go up, maybe we consider a trade on that. Or other companies in the space, Chevron, Texaco, Occidental Petroleum, ConocoPhillips, COP. These are all stocks in that space that in theory would benefit as oil prices go up. Okay. What about aerospace and defense? Well, you can look at, here's Lockheed Martin. You can look at that. Northrop Grumman, you can look at that. Raytheon, RTX technically, I guess, but Raytheon. Those would all be ones that likely, no guarantee, would benefit. General Dynamics, these are all defense contractors. All right. So these are the types when you're trading, come up with the theory, as to what the market's going to do or what a particular industry group is going to do, and then you trade on the theory. All right? So you can do things that are taking advantage of higher implied volatilities. John the Noble Savage said, now could we be selling puts? You could be selling puts. That's a bullish strategy. This is more an advanced options class, so we're not going to just do sell single puts here. But your instinct is correct on that, I think, John, in terms of thinking about volatility. Now, you can also break it down further. I've talked about AI a couple times. I was thinking, a thought came to my mind is, you see the Patriot missile in the news. Who makes Patriot missiles? As much as I love the Thinkorswim platform, I don't know a quick way to figure that out. I used AI. Who makes Patriot missiles? And it turns out the radar and control system, the launcher, is made by Raytheon RTX. And the missile itself is done by Lockheed Martin. Okay. I didn't know that. You can Google it, whatever, use AI, whatever. You can do it that way. And maybe is kind of may affect what your trades are. But let's look at ExxonMobil here. Okay. So here's ExxonMobil. I'm going to consider more of a bullish trade on this. And what I'm going to do is I'm going to sell some options, and I'm going to do what sounds kind of weird, and that is I'm actually going to sell an iron condor on this. But you'll see that it's not going to be your normal iron condor where I have a short call vertical above and a short put vertical below, and they're kind of equidistant, and we hope this stock just goes sideways. Because you can always skew these if you want. So for example, if I'm looking at this stock and I'm saying, look, I'm guessing we have support around 150-ish, somewhere in here. I'm guessing there's support around here. So I'm looking for something where it's going up. Let's do a trade where we're okay if it kind of goes sideways maybe, because frankly, a lot of price increases are already priced in. Not all of it probably, but a lot of it's priced in. And so I'm going to say it can go sideways or it can go up here. So let's do that. So I'm going to go, we'll go to the trade tab. And I'm just going to go out to a little while. I'm going to go out 42 days, maybe a little bit longer than we typically do on these iron condors, a little bit more than a month away. And I'm going to sell, what did we say? We said about 150 is about support, kind of where we are. So I'm going to sell that for the put side of things. Now that's almost at the money. Okay. I guess technically that is the at the money contract. 44 delta here on this. I'm going to sell this. And I'm going to buy, hold down my control key, and I'm going to buy that. Okay. $10 spread on this. And I'm going to widen it out a little bit here. On the call side, I'm not doing that the 44 delta. On the call side, I'm going to go up to like 170. What's my delta here? 170. I'm giving it more wiggle room, like 17. Okay. So I'm going to sell this, hold down my control key, and I'm going to keep them equidistant. I'll make them $10, 180. Okay. So, and I'm also going to do one other thing here. Okay. I'm also going to tweak the number of contracts. Notice this is 1111. If I change this right now, it changes all of them. Well, I don't want to change all of them. I want to change the put sides, but not the call sides. So the way you do that is where it says Iron Condor, click on Custom. Then it will allow you to individually change each of these. And I'm going to do 2 on the put side and 1 on the call side. So I've kind of skewed this thing. I'm going to right click on this. I'm going to analyze this trade. So here's the trade. Let me just kind of shrink this down so you can look at it. So this is what it looks like right now. Our stock is right here right now. This is a bullish trade. positive delta. Can you see why that is? Well, if the stock's here, if it goes up, we're in great shape. At a certain point, we're not in great shape, but it'd have to go up quite a bit, above looks like 177 or so is the break even on that. Okay. Theta. Well, we're going to be positive theta on this. Time decay is going to help us out on this trade. Positive theta on this. You can see that again right here. There's our positive theta on there. Now, let's look at this. You can see it's not a symmetrical trade like an iron condor often is. There's less risk on the high side. Here's the break-even point. Here's the loss on the high side versus we'll get to the low side in a sec here. But right now I can see my max loss over here. I'm just looking in this bottom left corner is about 293. Gain 707. That's great. So, but on the low side, there's a lot more risk on this. That's why we're going to put an exit on this as well. So does this match your forecast? Neutral to bullish. If it goes above 177 is kind of our break even there. Let's look at that chart. So, I mean, if it goes super bullish, then from here, that could be trouble. But we've just taken an iron condor, a trade that you certainly wouldn't normally consider to be a bullish trade, and made it a bullish trade there. So when you're doing advanced options, think about your forecast. Think about things like your theta, and maybe your vega too, right? This is going to be a vega negative trade. If implied volatilities go down, that would tend to help. Now you may be going, implied volatilities are high, Brent. Let's look at implied volatilities real quick. They are. How long are they going to stay high? I don't know. But they do tend to revert to a mean eventually on those. So there we go. So anyway, so let's do this. I'm going to before I enter the trade, I want to consider an exit. We said if we break, I'm going to say if we break support here. I'm going to say if we go below about, well, there's my support, 146. We're going to say about 145. Let's just get out of this trade. So let's do that. Let's put in our trade. I'm going to create an opposite order. Make it first trigger sequential. Right click. I'm going to create an opposite order. And I'm going to get out at market. Good till cancel. If the stock goes below 145. I'm going to click on the gear. And we're going to say if ExxonMobil marks less than or equal to $145. Save, confirm, and send. And I'm going to put this in my iron condors bucket. Now, when we look at this, hasn't filled yet, but we'll let that work a little bit. I probably needed to change the price because it went in at that mid price, which is unlikely it's going to fill right away on that. But there you go. But we'll monitor that, and we'll look to get out if necessary. Sometimes you may elect not to get out. Let's look at that Procter & Gamble trade. We'll look at some other trades, new trades here in a sec, but this is the trade from last week. This is the one that I said went completely south on us. Let's look at Procter & Gamble. Here's the stock. We were bullish. We got in back here. It went down on us. But in terms of management, if we go and look at this, our current price is down here right now. So in terms of management, so here's our current price right there. In terms of management, we have to ask ourselves, how much more are we going to lose on this? Obviously, it's not going well. Look at the difference between the purple line and the blue line. They're pretty close to one another. That's probably a pretty good indication we've lost most of what we can lose on this. But one reason why traders do spreads is that spreads limit risk. Okay, they limit risk. That's why if we are bullish, we won't just do, sometimes we won't just do like a short put. We can limit the risk on the downside. In this case, we have a butterfly spread, an unbalanced butterfly, but you can see the risk here compared to what the potential reward was. Well, it went down on us. Another way to kind of consider this is this. These calls on this, if you look at the current price on these, look at the mark price on these, there's not much value left in these at this point. In other words, we can't lose. The worst these can go is just go to zero. Everything just goes to zero. That's the worst situation we have on this. Aside from early assignment or something, but we're probably not going to let, we may not let it get to that point, but if it's this far out of the money, early assignment becomes much less likely. But we've lost almost what we can lose on this. Is there a chance that we may get a bounce here and it may go up and restore some value in this? There is. So I'm going to let this run a little bit further. So we'll continue to look at this. And by the way, this whole portfolio, not just condors, calendars, and butterflies, but when we look at diagonals and long verticals and single options and synthetics and everything, I manage those in the Managing Your Options Portfolio webcast, which occurs on Wednesdays at noon. So that's the main area where I look at the management of these. Okay, so let me go back here, and I'm going to look. Here's this order that we just placed. So I'm going to cancel and replace it because I just want to get filled. See, it's off the mid price, it's less likely to get filled. So I'm going to put it there. And we're going to send that and see if it fills. There we go. We filled it. We got our iron condor now. Okay, let's look at some others. Let's talk about another category that maybe we could, let's look at CrowdStrike. What's CrowdStrike? CrowdStrike is one of those cybersecurity firms. Okay, you can see the nice run up we've had here lately on that. Other companies that kind of are in the space, Palo Alto Networks. I'll come back to CrowdStrike, but it's PanW, Palo Alto. That's a kind of same chart, right? Looks very similar on that. Fortinet is another cybersecurity type company you can look at. You can see the strength in these right now. And if the world becomes very peaceful in the next couple of weeks, these may not do as well. But I think this is an industry that a lot of people are interested in for the specific reason that we are in a rather dangerous world here. So again, we can look at various types of trades. Part of it may be the time frame on these. If you're using shorter term trades trying to take advantage of the time decay, then that's, our expiration date is probably going to be accordingly set, such as maybe a month out. We went out 44 days, I think, on that iron condor. That's a little bit on the longer side, but that's kind of in that time when time decay kind of is starting to help out. Let's talk about, let's see. Oh, so that, that's the time frame. What about longer term? Well, longer term we can do that, but theta is going to be less of a factor longer term. Keep in mind when we're trading and we got to consider, are we bullish or bearish? That's our delta. Positive delta or minus delta. What's the time frame we're looking at here? Shorter term move, longer term move. If we think this is going to be a longer term situation where cybersecurity benefits, maybe we go for a longer term trade on whatever stock we're looking at. In this case, our example is going to be CrowdStrike. We can look at theta. Is theta helping us or not? Generally, it's nice if theta helps us, but it doesn't, not all trades, especially trades where we get a super big benefit if we get a big move in the stock. Theta, sometimes we can't have it be positive. So we'll try and minimize that. So that may be a factor. Vega, implied volatility. That's another factor you may consider here. Implied volatilities are higher right now, but it's not so much where they are right now, it's where you think they're going to go into the future. All right. Frank said Zscaler. Martin said Palantir. These are all companies in that space that you could look at. No doubt. Thank you for contributing that, by the way. So there's a lot of companies. I'm just using CrowdStrike as their example here on this. But if I want something that's a little longer term, I can go here and I can say, well, this is something, I think it's going to be good for a little while. Pick your days. Let's go out 100 days. Okay. 100 days. I can do a synthetic on this. I can buy a call. That's 430 call. I can sell a put. Let me analyze this. Here's our trade. This profit loss is going to look an awful lot like the stock. If you don't believe me, what we could do is we could also do this, and we can analyze this too. Analyze trade. Now, when we look at these, one sec. Here's what the synthetic looks like for our reward to risk, our profit loss graph. And here is what 100 share stocks look like. About the same, right? Now, it's not exactly the same as the stock. The synthetic that we're looking at here is, it has an expiration date, June 18th. I don't know if CrowdStrike pays dividends or not. One way you can find out is just go to the trade tab, click here, and you can see no dividends, doesn't pay a dividend. So that's not going to affect us there. But that's just realize it's not stock here, but it's a synthetic. And with the synthetic, our theta is going to be reduced. It's not exactly zero. It may be slightly positive, it may be slightly negative, but for a big impact trade, that's not a very big theta there. Our delta, it's about 100, okay? Pretty close to just buying 100 shares of stock in terms of delta. Our vega, it's very reduced. Why is that? Well, I have a long call and I have a short put. And so the vega and theta, your Greeks are mostly just going to cancel each other out on those two, okay? Delta, they don't cancel out because a long call is a positive theta, or not, positive delta trade. A short put is a positive delta trade. They're both going to be in the ballpark of a 50 delta, and hence we end up with 100 delta overall. Okay. So question in the chat. What do I mean by synthetic? A synthetic is this. Think about the term synthetic in life. What does synthetic mean? You use a synthetic oil in your car. Well, it's a substitute for the real oil. It's not the real oil, but real oil, it's a substitute. Or synthetic anything is just a substitute. It's meant to mimic a real thing. In this case, this is meant to mimic stock ownership. It's not. I already discussed a couple of reasons why it's not exactly that. But this is an expensive stock. This is a $430 stock or something like that. Well, how much would 100 shares, how much would it cost to get 100 by 100 deltas worth of stock of a $430 stock? That'd be a $43,000 investment here. How much is this synthetic going to cost? less than 400 bucks, okay, up front. Now, you may go, that's awesome, great. I want all that great upside with hardly any, down payment, so to speak, in other words, an upfront cost. But keep in mind, this is just a very leveraged trade. We can get the same movement of the stock with very little down payment. Think if you're buying real estate or something, and you put a very small down payment on it. That may work out great for you if the real estate goes up in value. But if the real estate goes down in value, furthermore, there may be if there's an expiration where you have to get out of that real estate at some point, you could be in big trouble if you put that small investment down and the whole property goes down in value. So there's pros and cons on this. But that's the purpose of the synthetic is we get the same kind of movement of the stock in terms of delta with very little option Greek impact there. Okay. Now, there we go. Question from Zach. If I wanted to on this trade, could I sell calls on it? Yeah, I could sell calls on it. I could sell a call. Let me get rid of that doodling there. I could sell a call at a higher strike price. And if I were to do so, okay, what would the graph look like? Well, it'd be kind of like a covered call in that regard. Selling calls would bring in a premium, which is nice. So it would actually shift this graph up just a little bit from the premium. But then it would cap out our gains. It'd look kind of like that if I added a short call on top of that. Okay. It's not technically a covered call, but it would look pretty similar to a covered call on that. Okay. So could I sell short calls on this to Zach? Yes. Martin says, could I protect it? Yeah, you can protect it just like you would a stock. James answered that in the chat. You could buy a put. That would protect the downside. Now, if I were to if I were to buy that put, what would happen? Well, I'd shift the whole thing down a little bit because there'd be a debit up front on it. Okay. But then at some point, we'd limit the risk on that. That's what it would look like if there was a long put. Okay. Next, Wiley says, what about a caller? Well, a caller, we're doing both. We'd be selling the call, we'd be buying the put, and you're just limiting the risk on that. So I'm not going to do that in this case, but you guys are thinking, that's awesome. You're using your heads. Once you know these option strategies, you can have thoughts like, I want to protect this and I'm going to do this trade, or I want to, bring in some more income. I want to do this trade. But just realize the consequence. Bring in more income with a cover call or a short call. Yeah, but I'm limiting my potential gain on it. So I'm not going to do that in this case, but that's a trade that would benefit if this stock goes up. And again, what we could do is we could say, look, I think this is going to go up, but if we start to break down significantly, let's say we call this kind of a potential area there, a little bit below 400, 390. Let's say we're going to get out in that case, below 390. So let me get rid of that. So how did I do a synthetic? You just go to where you want. You can buy the time frame that you want on this. That is no problem. The farther out you go, the more expensive the calls are going to be, but also the more premium you'd be bringing in from the short put. So they really offset each other to a large extent. Typically, we're going to do the same strike price on call and put here. So in this case, I did call. I lost my cursor. And I did what? Did I get that? Yeah, I got that right. Okay. And we could put that exit in if we want. I'm going to do the same thing. I'm going to right click, create, I'm going to create a opposite order to get us out. And I'm going to do the same thing. I'm just going to make that good till canceled and put my exit in just in case, just like you would consider doing on a stock. The management of a synthetic is going to be very similar to the management of a stock, right? We have expiration dates you need to consider. But in terms of technical analysis, when you're looking at things like trend and support and resistance and things like that, that's from a technician standpoint, that's probably how you're going to consider where to add a stop there. Less than 430. Not 430. Hold on one sec. I forgot where we said we were going to put that stop. Oh, yeah. So support around 380 or something. I'm going to go to about 370 or so. Just click this. Try that again. What is happening? Why is that not working? Let me just toggle this and see if I can get that to go. There we go. Mark less than or equal to. Save. Confirm and send. Actually, before I do that, again, it's putting it at the mid price. Okay. Confirm and send. And we're going to put that right there. Okay. There we go. Okay. There's that. Okay. All right. So, question from Cola. Why am I talking about synthetic when we're doing condors, counters, butterflies? That's the general name of this class. It's an overall advanced options class where we talk about that. If I am just strictly doing condors, calendars, and butterflies, those are all neutral trades. Well, we want to be able to expand a little bit out of that. So yeah, we go beyond just condors, strict condors, calendars, and butterflies in this webcast. Yep. So there we go. So instead of putting on a stop, we could buy a put and not get stopped out. You're right. We could have done that. That's another way of doing it. Pros and cons. Stop orders versus long puts. Stop orders have some pros. Remember, stops don't guarantee us an exit. Okay. And technically that wasn't a stop, but it was an order-based condition to get out like a stop. But it doesn't guarantee us an exit. So that's definitely a downside on there, especially, if CrowdStrike tumbles very quickly. Do you remember what was it? Maybe it was probably a couple of years ago almost now, that CrowdStrike had that outage that affected all these businesses across the country. And it was some software hiccup in their domain there that messed it up and they tumbled quickly. Maybe there's something huge that comes. The stop's not going to get you out. That's the benefit of doing a long put if you're going to do that to protect you. Okay. Now, there's a downside though. The downside is long puts cost money. And they also introduce more, that synthetic we were just talking about on the synthetic, theta is pretty neutral-ish, right? Because the theta mostly cancels each other out. If we add in another long put, we're introducing a pretty significant amount of negative theta into that trade, and there's an upfront cost, so we're going to be moving up the break-even point. We really needed to be bullish at that point. I'm not saying not to do it. I'm just saying know your pros and know your cons on those. Okay. Martin says, with volatile stocks, long puts may be better. That may be the case. It can certainly help you and it can add protection in. But also keep in mind, with volatile stocks, it's also going to cost more because of the higher implied volatilities. We have a 52% IV right now on this. And for those of you who aren't familiar with this, 52% is the implied volatility average for this month, which is June, which implies, given it's an expensive stock, it implies almost a plus or minus $100 move in the stock. That's big move. So to Martin's point, that is a volatile stock, no doubt. But you're going to pay, even if we go out of the money, so let's say to a 33 delta, for example, on this, out of the money, it's still going to cost us about $2,900 for the long put there on that, if we were to do that contract. So that, it affects the trade. It's a fair trade. It's a fair question, and I'm not trying to tell you one way or the other, but the great thing I'm hearing from you guys is you're thinking about it, about the pros and the cons of it. And that's when that's the beauty of options in that regard. There's downsides, no doubt. But what I mean is they're very malleable. They're very adjustable to what you need them to do. When people talk about options, a lot of times it's leverage they're looking for, or maybe they're looking for income, or they're looking to protect parts of the portfolio. One of the benefits of options is they can fit different profiles. If you want something bullish, bearish, neutral, you can do that, and you can control the risk on those. Okay, I don't have time for another trade, but let me just kind of tell you the lines I was going to go on if I had a little more time. We talked about what we did. We did ExxonMobil. We talked about trades that are, types of industries that may do better in this kind of war environment where other things aren't doing so well. We looked at ExxonMobil as an example of something in the oil and gas space. We looked at CrowdStrike in the cybersecurity space. If we had more time, I was going to look at either Newmont Mining, and again, these aren't recommendations. These were the examples I was going to use, or Barrick Gold in the precious metals gold space. Keep in mind when we're looking at these, there's more stocks out there. I mean, there's a lot of stocks in all these categories out there, but if we're doing options, they need to be liquid. So I was looking at a bullish trade on Newmont Mining or Barrick Gold, and I was going to look at possibly a bullish trade on either General Dynamics or Raytheon in the defense space. And I looked at a couple others. Liquidity, watch out that liquidity. Northrop Grumman, I looked at NOC and Lockheed Martin. Liquidity was a little suspect on those. Okay, so just double check on those. All right. Okay, everybody, thank you for joining me today. Coming up next, we've got market and sector analysis. James, thank you for helping me on the chat. And just remember, everybody, right now, you are looking on YouTube on the Trader Talks channel. If you want more content, including playlists, go to the Trader Talks channel. And when you do so, just subscribe, first of all. That's the key. Just subscribe, and then you'll make it easier to find it and go to it. And then you can see all the playlists, including classes by James or myself or other coaches out there. So I think it will benefit you. Thanks for joining me, though. Thanks for all your participation. Have a wonderful weekend, and I hope everything goes smoothly. And hopefully, hopefully next week, we're saying, hey, what if the war comes to a quick end, and we have to find stocks going the other way there. So We'll see. Anyway, everybody, have a wonderful rest of the day. Nice weekend. We'll talk to you later. Bye-bye.